It's the last edition of Business Incorporated for the week. You're welcome. I'm Ini John Mekwa. And coming up on the show today, the International Monetary Fund warns that vaccine woes may slow rebound in sub-Saharan Africa. Food and Agriculture Organization and Africa Union to boost intra-African trade in agriculture production. Ghana's March inflation rate rose to 10.30%. We begin the show with intraday market numbers which were positive. The JSE in South Africa rose 0.88%, while Nigeria's main index was marginally higher by 0.01%. The market in Egypt closed for the week positive on Thursday, while Kenya ended Thursday's session positive. Markets in the Gulf region ended for the week positive on Thursday. In the UAE, Dubai's index jumped 2.45%, while the Abu Dhabi index advanced 1.53%. Elsewhere in the region, the Qatari index gained the most by 2.77%, while Saudi Arabia's market rose 1.42%. European markets traded higher on Friday after notching record highs the previous session as global stocks take heart from strong U.S. economic data and recovery prospects. Chelsea has more updates for us from the European scene. Hello, Chelsea. Good afternoon and welcome to the show today. Well, Mercedes-Benz parent Daimler said Friday its first quarter earnings were significantly better than expected. How did the automaker manage to outperform?
Well, there's really one word, and that's China. Daimler, like many automakers here in Germany, is very dependent on the Chinese market. It does about a third of its business there. And because the Chinese economy has been so strong over the past few quarters, that's really helping to really lift Daimler's business. Today, we also heard that China's GDP rose by about 18% in the first quarter. That's in part because the last year China was really in a hard lockdown, so there was a bit of a skewed comparison period, but the Chinese economy is very strong, and we're hearing repeatedly from Europe's largest companies that that's really starting to help them. So it's not just Daimler that's benefiting in China, it's also BMW, which reported that its sales have fully recovered and are now once again growing in China. So that's really helping to offset some of the weakness in the European market for these companies.
Well, the head of European budget airline Wizz Air says he no longer expects a rebound in European travel this year due to bloc struggling vaccine rollout. When can we now expect travel to pick up again?
Well, this is a topic very much in dispute right now in Europe. Wizz Air is coming out quite pessimistic here. They had hoped to operate about 70 to 80% of their capacity in the summer as countries drop travel restrictions, as vaccines progress, but really we're not seeing that at this point. Here in Germany, they're talking about instituting an even harder lockdown. So the hopes for being able to travel again seem a little bit farther away than a lot of people had expected. But we have heard other more optimistic forecast, for example, from EasyJet earlier this week. They said they actually think they will start to see travel restrictions come down potentially in June. So there is obviously a lot of speculating here on when Europe will be able to reopen, when it will be able to get the coronavirus under control. But I think for now, the virus situation is really going to be the main determinant, and many countries are still very much in the throes of a third wave.
Well, more than 400 financial companies have moved staff to Europe in the wake of Brexit. Who's benefiting from this shift?
Well, this report really paints a picture of a lot of European countries benefiting from this shift. In total, about 440 financial firms have moved business outside of the UK because of Brexit. The top beneficiary is Dublin, which makes sense given its proximity to the UK. But Paris, Frankfurt, Amsterdam, Brussels, really a wide range of countries are starting to see more and more financial services shift to the EU, and that's in part because because the EU and the UK are still working on a deal about how to really regulate financial activity between the two. There's a lot of new changes because of Brexit that mean a lot of that there's a lot more complications and there's a lot more regulatory requirements on firms in the UK. So there had been hope that the UK and the EU would be able to reach a deal that would allow businesses to stay in the UK and continue operating in Europe. But so far we haven't seen that, and the prospect still looks a little dim. So for now, the shift is likely to continue until the UK and the EU can come together on how to regulate the financial services industry now.
All right. Thank you so much, Chelsea. Thank you for all the information, and enjoy your weekend. Well, we move over now to London, where trade between the European Union and the UK has continued to be a major talking point post-Brexit. But how had that fared so far? Juliana Olayinka joins us to tell us about this development from London. Hello, Juliana. Good afternoon.
Good afternoon.
Yeah, well, a report released this morning by Eurostat shows that UK exports to the European Union have almost halved so far this year, and this is widening the EU's surplus with the United Kingdom. Can you tell us more about this report?
Well, yeah, this is a European report conducted by their stats counter, as you said, Eurostat, showing that trade surplus has increased, even though we do know that, of course, the Brexit disruption and the pandemic has caused a bottleneck. It has actually increased in the month of February, and with the outlook that we've seen for the month of March. But, of course, we're looking at this data through the rearview mirror, showing that year on year, imports from Britain fell 47% and exports slumped 20.2%, which is why there is this trade surplus. Earlier this week, we did actually discuss, the details from the Office for National Statistics, showing that even though trade between Britain and the bloc is still below pre-Brexit levels, there has been an increase. I think one of the reasons why exports from the EU into the UK have fallen so dramatically is because there's been so much bureaucracy and red tape. A lot of not just big businesses but customers have complained that if they're ordering, let's just say, a pair of shoes that cost a certain amount on the sale, by the time it's got to your doorstep, you're paying surplus fees because of VAT and extra added taxes. So it's a massive issue, and I believe the two sides are hoping that once we get out of this first quarter, the data will start revealing that there's been a pickup.
Well, online grocer Ocado says it invests £10 million in self-driving vehicles company. Any idea why the grocer is making the decision at this time?
Yeah, it's an interesting story, actually. Ocado, they are an online grocer, the first and only online grocer, well, predominantly online grocer here in the UK. But apart from delivering shopping, they've really tried to emerge and rebrand themselves as being a first for using a lot of machine learning and artificial intelligence to help pick their grocers and deliver the items. Now, they've put this stake, this 10% stake in Oxbotica, which is a British-based company. They've just gone through a round of funding where they raised money in China, here, and in the American market. We know that Ocado was part of raising that figures, and what they want to do is be given the green light to start delivering groceries with automated vehicles, driverless vehicles, which is pretty interesting. So this is a very early stake in what could potentially be a pretty lucrative business. But bosses at Ocado did put out a warning trying to temper expectations, saying that they are still waiting for regulators to give them a green light to be able to deliver groceries in such a way.
Well, exciting times await grocery marketing there in the UK. Well, yesterday we talked about the FTSE 250 doing so well. Now, the FTSE 100 has now broken through the 7,000 mark for the first time since February last year. What's the driving investor sentiment at the intra market, and what's the outlook for the next week?
Well, we discussed it on Business Morning earlier today, and of course it's got to be those pretty eye-watering figures we got from China, showing that GDP rose above 18% in the first quarter of the year, way above any similar type of economy. That certainly buoyed expectations for investors across the world, because of course China is the second largest economy and the world's biggest factory. When things are doing good there, you can expect to see a ripple effect, which is why we saw the FTSE open up in positive territory, and as you said, that 7,000 mark being broken for the first time in well over a year, and it has maintained that level at intraday. Also as well, next week we do have a pretty busy data schedule. I'm sure we'll be busy chatting about this stuff. You've got unemployment figures coming for the month of February. That's due in on Tuesday. Now, we have spoken a lot about the labour market in the UK stabilising. I believe unemployment currently stands at about 5%. That's expected to be unchanged. And then on Wednesday, we've got inflation for the month of March. We know inflation has been a buzzword for investors across the world, so people will be keeping a close eye on that. We are expecting to see it rise from 0.4% to about 0.8%, still well short of the Bank of England's figures. And then on Friday, we're going to wrap it up with PMI figures for the month of March. This is really the only way we can have a proper look at the private sector in the UK. We've had really positive PMI figures already, so we're expecting to see that the kickoff for Q2, so those are PMI figures for April, are going to be positive as well. So let's look at the FTSE All-Share numbers before we wrap up. The FTSE All-Share is up 0.64%, the FTSE 100 is up 0.73%, and the FTSE 250 is up by 0.40%. In the currencies market, the British pound is up on the US dollar by 0.06%, down on the euro by 0.10%, and up on the Japanese yen by 0.07%. Thank God it's Friday, innit?
Yes, you can say that again. And you have a lot of work ahead next week, so you need a good weekend, you know. All right, Juliana, do take care and enjoy your weekend. Okay, so shares in Asia Pacific were largely muted in Friday's trade as investors reacted to the release of Chinese economic data showing GDP surge 18.3% in the first 3 months of the year from a year ago. Mainland Chinese stocks declined as the Shanghai Composites gained 0.46%, while the Shenzhen components slipped fractionally. Hong Kong's Hang Seng Index hovered above the flat line. The Nikkei 225 in Japan was 0.11% higher, while the Topix Index stood a little changed. South Korea's Kospi was about 0.1% lower, while Australian stocks slipped as the S&P AX 200 declined around 0.1%. MCSI Broadest Index of Asia Pacific shares outside Japan was also a little changed. In the United States, stocks futures were little change in early morning trading on Friday after the Dow Jones Industrial Average crossed the 34,000 threshold for the first time ever. Futures on the Dow Jones Industrial Average gained just 16 points. S&P 500 futures added 0.07%, while Nasdaq 100 futures were lower. During regular trading hours, the blue chip Dow rose 300 points to top the 34,000 milestone amid blowout economic data. The S&P 500 and the Nasdaq Composite gained more than 1% each on Thursday. Investor sentiment was boosted by economic data on Thursday that pointed to a rebound in consumer spending and the jobs market. We'll go to the oil market now, where prices dipped in early trade on Friday, but were on course for a weekly gain of more than 6%, with an improved oil demand outlook and strong economic recoveries in China and the United States offsetting concerns about spikes in COVID-19 infections. Brent crude futures fell 0.3% to $66.77 a barrel, while U.S. West Texas Intermediate crude futures were down 0.3% to $63.27 a barrel after climbing 31 cents on Thursday. Strong economic recoveries around the world and supply curves by OPEC and its allies, together called OPEC+, as well as a cautious response to higher prices by U.S. oil producers are supporting the market. For the moment, a strong jump in U.S. retail sales, a drop in unemployment claims, and signs of more cars on the road in the world's biggest economy buoyed the market. And in the metals market, gold held steady near a more than 1 month high on Friday, en route to its second straight weekly gain, boosted by a drop in U.S. Treasury yields and a weaker dollar. Spot gold was up 0.1% at $1,764.13 per ounce, while U.S. gold futures eased 0.1% to $1,764.40. Among other precious metals, silver slipped to 0.1% to $25.83 per ounce. Palladium was steady at $2,742.18, but up about 4% for the week, while platinum gained 0.4%. We'll bring you more stories across the African continent when we return from the break. You're welcome back. Investors' interest in Africa from the Arabian Gulf continues to gain momentum as government-backed investment encourage private sector entities to enter the continent. As of December 2019, the trade volume between Nigeria and the United Arab Emirates was $1.5 billion. Now, what's driving this interest and what opportunities are available for the Nigerian community? Richmond Eke, an investment analyst, talks to us about this. Hello, Mr. Eke. Good afternoon and welcome to the show. Well, can you tell us more about this issue with the Gulf region's interest in Africa?
Thank you so much.
Yeah, you're welcome. Well, does it go beyond trade? We know a lot of trade goes on between Nigeria and the UAE. What's driving it, and does it go beyond this trade that we hear about?
Well, Africa and the UAE have had a long-standing trade relationship and investment relationship over the past few decades. But now what we're seeing is that that relationship is beginning to become more strengthened, due to so many opportunities that lie across the four corners of the continent. And, just like you mentioned, trade between Nigeria and the UAE currently stands at around $1.5 billion US. And we're seeing that same trend basically across the entire continent. Just to put that in context, over the past decade, we had non-oil trade reach over $207 billion. And right in the heart of the pandemic last year, just in the first 9 months of last year, we saw non-oil trade reach over $40 billion. So there's a lot of opportunity in Africa right now that investors in the Gulf region are really looking at and are really looking to explore.
When you say there are opportunities, what are these opportunities? Are they manufacturing? What exactly are they?
Well, I think first of all, one of the key drivers is the fact that Africa is going through a digital revolution. Nigeria alone has over 200 million internet users with an internet penetration of 50%. And then what I believe we're going to see over the next few years is there's going to be a lot of innovation and economic growth just due to tech. So tech is one of the sectors that is very key. One other area that I'm very excited about is the area of food security. And that's one of the areas that the UAE and Africa have been conducting trade in the past few years. And I believe strongly that investors are going to look more into the agri-sector and the ag-tech. We're going to see more investments in healthcare, more investment in infrastructure as well. But most importantly, I believe the human resource on the continent is what is most prominent about Africa. And we're going to see more investment in the people. We're going to see more multilateral trade in that sense, basically between both regions.
All right, Mr. Ike. So when you mention all of this, there are laws to be followed.
Hello,
there are
can
rules.
you hear me, please?
Yes, I can hear you. So there are laws to be followed. So what way or how can entrepreneurs in Nigeria tap into these opportunities? Do they just wake up and go to the UAE and start doing business? Or what are some of those steps that they can take?
I'm sorry, can you come again? I think I lost you for a bit there.
Okay, so I'm asking that you have mentioned some opportunities, some areas, but how can, or what are the laws, what are the steps that can be taken that entrepreneurs can go through to tap into these opportunities?
Yeah, definitely. One key aspect is in terms of foreign direct investment into the region. One key thing about investors in the Middle East is that they're very fast, they're nimble, and they're highly ambitious, and that's something that we really need in Africa right now. So the opportunity for entrepreneurs, for founders within the region, is to build more relationships in places such as Dubai. Dubai has become a central hub for innovation, for finance, basically within the region. And we expect more trade, more interaction within the region. So actionable steps that could be taken are for entrepreneurs right here with great ideas, with great opportunities, to reach out to investors in the Middle East. There's a lot of dry capital in the Middle East, so uninvested capital they're looking for good opportunities, great opportunities. And founders can take that step to reach out to the family offices, the private wealth, the who are looking to diversify their portfolio, and bring some of that capital back to Africa. So those are some actionable steps that I think could be taken. And Dubai is already leading the forefront of that, just by being a hub. Yeah, pretty much. So there are opportunities such as the Dubai Chamber of Commerce, which is a very, very key initiative by the UAE government, basically, to drive investment into the region and foster trade. So those are some key aspects that entrepreneurs could look towards,
All right, Mr. Ike, we really have to take it there. Thank you so much for sharing your thoughts with us on Business Incorporated. We appreciate it. Well, the International Monetary Fund has said that new waves of COVID-19 infections could derail the economic recovery in sub-Saharan Africa, which is already forecast to lag the rest of the world this year amid limited access to vaccines. In its regional economic outlook released on Thursday, the IMF said that growth projections are subject to greater than usual uncertainty given the risks of further COVID-19 shocks in the continent, which relies on a World Health Organization-led initiative to provide vaccines known as COVAX. It further states that if supply and distribution issues continue, most countries will struggle to reach herd immunity before the end of 2023, and this will leave them exposed to new, more virulent strains of COVID-19. The Food and Agriculture Organization of the United Nations and the African Union Commission have launched a guide to boost intra-African agricultural trade under the new African Continental Free Trade Area Agreement. According to the FAO and AU, increased agricultural trade between African countries can drive sustainable development and play a pivotal role for the transformation of food systems. The framework for boosting intra-African trade in agricultural commodities and services, which is a blueprint for expanding agricultural trade between African countries, aims to unlock the potential of the agricultural sector to contribute to sustainable, inclusive growth for Africa. And Ghana's March inflation rose by 10.30% compared to the previous month. The headline inflation increased by 0.9% month-on-month. The increase was primarily due to faster increase in rent prices, specifically the housing, water, electricity, gas, and other fuels basket rose to a 9-month high of 5.1% month-on-month in February. It was 3.9% month-on-month in February. Consequently, the non-food prices rose by 1.4% month-on-month, the highest since June 2020. Meanwhile, prices of food and non-alcoholic beverages increased by 0.2% due to the slower price declines seen across vegetables. And that's the show for today. Thank you so much for watching. I'm Ini John Mekwa.